Just 48 hours after the tariff hike was announced, Walmart, the largest retailer in the U.S., shut down multiple major distribution centers. Over 100,000 jobs were lost. What exactly is happening? A system built to perfection suddenly breaks. Walmart has long been known as America's logistics optimization machine. With hundreds of distribution centers spread across strategic states, from California to Arkansas, every pallet, every truckload is timed to the minute. Everything ran like clockwork. But a single change from Washington shattered the entire system. When the government officially imposed high tariffs on a wide range of imported goods, from electronic components to consumer products, the entire supply chain was thrown into complete uncertainty. Import costs surged by 15 to 20% within days. The result? Dozens of once profitable centers suddenly turned unprofitable. For Walmart, where profits are calculated down to the penny, that spike was unabsorbable. CEO Doug McMillon had no choice but to make an unprecedented decision: shut down multiple distribution centers across the U.S. Soaring costs, empty shelves, a market in turmoil. Rising costs were one thing, but what truly overwhelmed Walmart was the sheer volatility. Tariff rates changed too quickly. No one knew what next week would bring. All forecasting became meaningless. Walmart's finance team had to build emergency models, running through dozens of scenarios. The result, under current conditions, continuing operations would mean losing tens of millions of dollars in just one quarter. Especially in the Midwest, where goods are shipped inland from Pacific ports, domestic transport costs jumped by double digits. And the impact extended far beyond the balance sheet. Store shelves started emptying. Online orders were delayed due to halted fulfillment centers. Customers were confused, unable to purchase items they had come to rely on. And something unprecedented happened. Walmart lost control of its own supply chain. Chain reaction, satellite businesses, and communities collapse. Each Walmart distribution center isn't just a warehouse, it's a job hub for the entire region. When one site shuts down, thousands lose employment. Drivers, warehouse staff, repair workers, food service teams, packaging suppliers, all swept into the chaos. Across the country, more than 100,000 people were directly affected within just a few weeks. Towns that depended on Walmart slipped into crisis. Local revenues fell sharply. Small vendors who had exclusive deals with Walmart saw contracts frozen and faced the threat of bankruptcy. Even businesses that had just expanded their operations to serve Walmart were now forced to lay off staff or shut down machinery. This was no longer a business decision. It had become a widespread social crisis. An unexpected response: AI and localization of supply chains. But Walmart didn't sit still. Right after announcing the closures, multiple task forces were mobilized at headquarters. They began redesigning the entire supply chain with three core strategies. First, investing in AI. Walmart's engineers worked with machine learning experts to develop real-time monitoring systems for trade policies, from government statements to port disruptions and freight fee trends. Second, expanding domestic sourcing. Walmart proactively signed deals with U.S. manufacturers, especially in the Midwest and Southeast, to replace imported goods. Third, building a new distribution network. Instead of relying solely on mega hubs, they tested micro-fulfillment models, small flexible warehouses that can reroute goods quickly without depending on ocean freight. This marked the strongest transformation in Walmart's 60-year history. Just one policy move can force a commercial empire to stop and reevaluate everything. But more importantly, Walmart's response, restructuring, localizing, deploying AI, working with government and workers, proves one thing: in the storm, there is still a path for those willing to change.
This warning from the CEO of the nation's largest automaker, General Motors, about the impact of the tariffs on the car industry.
He's announced a 25% tariff on all cars imported into the United States.
And it's likely to increase the prices for consumers.
Laying off 8,000 employees as it looks to cut additional costs.
GM has suspended production at its U.S. plants, cutting thousands of jobs, including 1,200 in Canada and nearly 200 in Michigan. This is not due to a recession or supply shortages, but a strategic decision to shift to electric vehicle production. Economic situation and GM's decision. GM, one of the biggest automakers in the U.S., has decided to stop production at several plants, directly affecting thousands of workers. This decision is not a result of a recession or chip shortage, but rather a bold strategy to shift towards electric vehicle manufacturing. As a result, 1,200 workers in Canada and nearly 200 in Michigan have been laid off, with over 500 workers possibly not returning once production resumes. This shift is causing cities like Detroit and Windsor, Ontario, to face severe economic downturns. Workers who have lost their jobs are worried about their futures, not only because of the jobs lost, but also because of the difficulty in finding replacement employment, especially as the auto industry is rapidly transitioning to electric vehicles. Moreover, car prices are rising, making it harder for consumers to afford new cars. The combination of rising car prices and job losses will put a significant financial strain on families, especially those dependent on the automotive industry. GM's move towards electric vehicles may be necessary to keep up with the trend, but it also leaves a range of unresolved issues for workers and the local economy. Donald Trump's reaction and global impact. Donald Trump immediately condemned GM's decision, calling it betrayal and threatening to impose a 25% tariff on all imported vehicles not produced in the U.S. This tariff policy not only targets GM, but also creates significant disruption for the entire automotive industry. Global manufacturers from the UK, EU, Japan to South Korea will have to adjust their production strategies to cope with this tariff. For GM, this response goes beyond profit loss. The company projects it will face losses up to $5 billion, mainly due to restructuring costs and changes in the supply chain. As essential raw materials for electric vehicle production, such as lithium, cobalt, and nickel, are mostly unavailable in the US and must be imported from Congo, Australia, and South America. This creates a major conflict between Trump's America First strategy and the globalization needs of electric vehicle production. The lack of these resources in the U.S. makes it difficult to implement tariff policies and forces automakers to reconsider their investment and production plans in the U.S. This not only impacts major companies like GM, but also adds pressure on the entire global automotive industry. Long-term results and personal difficulties. It's undeniable that GM and other automakers face significant challenges as they shift to electric vehicle production. However, maintaining tariff policies only makes the situation harder. Legislators are considering support for displaced workers, but tariff policies could permanently fragment the U.S. automotive industry. Families, workers, and small businesses are facing difficult decisions: postponing retirement, withdrawing children's tuition, or dealing with supply chain disruptions. They are facing severe financial difficulties while the car market becomes increasingly inaccessible. Global car manufacturers are reevaluating their investments in the U.S., which could cause further damage to the U.S. automotive industry. The community is also struggling with unemployment, reduced income, and the decline of the local economy.
The international credit agency Moody's downgraded the U.S.'s credit rating from its highest AAA rating to AA1.
Rick, there are so many things that are swirling around this. We know about the Moody's downgrade. We know that that raises some concerns about
budget. I would hope that the Moody's message and some of the agita that the media expressed when it occurred.
Did you know? The U.S. government's annual interest expenses have soared to a staggering $870 billion. And Moody's just downgraded America's sovereign credit rating from AA to AA1, the last step before losing top-tier status altogether. What do you think this signals for the world's largest economy? U.S. credit downgrade and debt inflation strategy. In May 2025, Moody's downgraded the U.S. credit rating. Why? Because interest costs are soaring, expected to consume nearly 30% of the federal budget by 2035, triple today's share. Imagine how much is left for education, healthcare, and development with such huge interest payments. The Treasury Secretary announced no spending cuts, but plans to let inflation erode the debt. Sounds clever, but risky. Real GDP growth is only 1.1%, while inflation hits 4.2%. This means bondholders get paid, but the real value of the dollar is shrinking. Confidence in U.S. bonds may waver, pushing yields up and making borrowing ever more expensive. This could be the vicious cycle America is facing: rising bond yields, USD decline, and China's retreat. Long-term bond yields have surged past 5%, folks. This shows growing investor anxiety. They demand higher returns to protect their money from losing value. Did you know? In just 1 month, the US dollar has lost nearly 4% of its value. A shocking figure. This not only spikes import costs, but also pushes domestic inflation higher, putting huge pressure on consumers and the overall US economy. Even more surprising, China, the US's largest creditor for 20 years, is quietly pulling back. They've slashed their US bond holdings to $765 billion and shifted to short-term investments to avoid long-term risks amid global turmoil. What if other investors follow suit? The US bond market would face massive pressure, yields would skyrocket, and borrowing costs for the US government would spiral out of control. This could force budget cuts on vital programs or tax hikes, directly hitting economic growth. But it doesn't stop there. This mass retreat could trigger a domino effect, shaking the entire global financial system. Not just the US, but the whole world would feel the impact. Do you think the US can escape this dangerous spiral? Or is this the warning sign of a new global financial crisis? Gold prices surge, allies reject trade demands, and Fed may need to intervene. Gold prices have soared past $3,200 per ounce, with experts forecasting a rise to $4,000 by 2026. This clearly signals investors seeking safe havens away from US dollar risks. As for trade allies, they're no longer accepting tough demands as before. These shifts erode trust and create turmoil in international markets. So, the big question: who will buy new US debt if this continues? If countries stop buying, the Fed will have to step in, buying government bonds to stabilize the market. But you know what that means. More money supply, heavier inflation pressure, further dollar devaluation, and a threat to America's global economic standing. Do you think the US can escape this predicament? The Abe credit rating, the symbol of financial safety, is now gone. Bond yields are rising sharply, inflation outpaces real growth, and major investors like China are steadily retreating from the US debt market.
71,000 containers stuck at ports. $28.4 billion in Boeing's market capitalization evaporated in just 48 hours. And this is just the beginning of the global shock called the US-China trade war. Ports are gridlocked. Retail is paralyzed. In early April 2025, the US announced a 145% tariff on over $300 billion worth of imports from China. In just 3 days, exports from China to the US dropped by 47%. In Shanghai, Ningbo, and Shenzhen, containers piled up. More than 71,000 containers were stuck. In California, 27 cargo ships waited offshore, with unloading times stretching to 96 hours, matching the record set during COVID. Container shipping costs surged from $1,950 to $6,820, a 250% increase in just 1 year. 10 days. Shipping companies began canceling contracts mid-route, citing unpredictable pricing due to sudden policy changes. Amazon, the e-commerce giant, canceled shipments on their way. Five Below, the discount retail chain, canceled $67 million worth of orders, equivalent to 11% of their Q2 inventory. China's retaliation: precise and quiet. On April 3, 2025, China quietly issued an order to halt all Boeing aircraft deliveries. No announcements, no arguments. In just 48 hours, Boeing lost $28.4 billion in market capitalization. 787 and 787 Dreamliner deliveries expected in Q2 and Q3 were all postponed. According to Bloomberg, this was a precise strike at America's #1 export symbol. Meanwhile, Airbus benefited. Shares rose 11.2% in Frankfurt as China redirected orders. This is no longer just trade. It's an attack on a symbol. And Boeing, as the industrial leader, is the most visible target. US auto industry in crisis. From chip shortages to soaring prices. The consequences spread from consumer goods to the US auto industry, Ford had to halt production of the F-150 Lightning, GM cut battery production by 60%, and Stellantis reduced production due to parts shortages. In the second week of April, 41,000 vehicles remained unfinished, resulting in over $1.6 billion in losses. Car prices surged significantly. Stellantis raised hybrid prices by 8%, and Ford increased the Mustang Mach-E price by $1,200. Even used cars saw a 4.1% price increase in just 1 week. The average price of a new car in the U.S. reached $47,770, an increase of $2,600 in April, relocating factories, scarce land, and risks in the shadows. In response, companies began relocating. Tesla moved Model 3 production to Berlin, Toyota reduced chip dependency by 30%, and Stellantis shifted production lines to Mexico. However, these solutions faced barriers. Hong and Cat Lai ports reached 94% capacity. India relies 60% on road transport, and Mexico increased waiting times at the Laredo border crossing to 12.5 hours. Moreover, China tightened exports of rare earths, causing Ford, Lockheed Martin, and Raytheon to experience critical supply shortages. The earliest forecast for alternative sources is late 2026. Meanwhile, China quietly sold U.S. government bonds, reducing its holdings to the lowest level since 2011. The number of container ships has dropped by 47%, and shipping costs from China have surged by 300% in just 10 days, directly impacting production and the distribution of goods. China halts Boeing deliveries, and U.S. ports face congestion. In April 2025, China halted Boeing deliveries, causing Boeing to lose $28.4 billion in just 48 hours. This wasn't only an economic decision, but a strategic move in response to new U.S. tariffs. Boeing, once a symbol of U.S. industry, is now a target in the trade war. This decision has led to the cancellation of several billion-dollar contracts and disrupted Boeing's production plans for the second half of 2025. Simultaneously, U.S. ports are grappling with severe congestion. The number of container ships has plummeted by 47%, and shipping costs from China have skyrocketed by 300% in just 10 days. The delay in contracts from Chinese shipping companies has caused a backlog of goods, especially in industries relying on Chinese components to maintain production. Amazon, one of the most affected companies, had to cancel over $67 million worth of orders. This is a massive shock to the U.S. consumer market, as products can't arrive on time, causing stock prices of many retail companies to plummet. The direct consequence? U.S. companies are facing severe supply chain disruptions, reducing production capacity, causing shortages of essential items, and driving inflation higher. Impact on the automotive industry and structural changes. The U.S. automotive industry cannot escape the crisis. Ford and GM have been forced to halt production of several vehicle models due to a shortage of key components such as microcontrollers and electronic parts. This has halted production lines, preventing the completion of many popular vehicles. This prolonged situation has caused car prices to rise dramatically. For example, the Ford Mustang Mach-E and Stellantis models saw a 6.8% price increase within just 1 week, an unprecedented surge in the automotive industry. In response to the disruption, Tesla has shifted Model 3 production to Berlin to reduce reliance on Chinese imports. Meanwhile, Toyota is adjusting its hybrid models to decrease dependence on semiconductors and parts from China. However, this is not a quick fix. The shift in supply chains has increased both the cost and development time of vehicles, resulting in higher car prices and longer delivery times. Moreover, China has restricted exports of rare materials such as dysprosium and terbium, crucial for the production of batteries and military equipment. This presents a significant challenge for the U.S. automotive and defense industries. Companies like Lockheed Martin and Ford are facing shortages of essential materials, and finding alternative sources from Australia or Canada will take at least until 2026 to be effective. Meanwhile, this shortage not only disrupts production, but also forces companies to compete fiercely for alternative supplies, driving up production costs and creating a large gap in the global supply chain. Production and global competition. While Tesla and other companies try to shift production, Rivian, Ford, and Chevrolet are ramping up competition with new electric vehicle models. However, rising component costs and longer delivery times have caused car prices in the U.S. to soar. Companies are facing reduced profits and a shortage of vehicles due to production disruptions. Issues ranging from supply chains to material shortages are forcing the global automotive industry to adapt quickly. Tesla and its competitors continue to search for partners to replace China. However, this process is far from simple and will take a long time. Can these changes help companies retain market share while minimizing the impact on consumers? The answer remains uncertain, but the emerging challenges are becoming increasingly clear. 42% of Americans have lost confidence. The Dow Jones is facing its worst April since the Great Depression, and working families are beginning to ask, what has really happened to the world's leading economy? Markets. Collapse. Citizens lose everything by the end of April. All three major U.S. stock indices plunged. S&P 500 down 2.5%, NASDAQ dropped 2.5%, and Dow Jones fell 2.48%. The shock was so severe that the Wall Street Journal ran the headline, "Worst since the Great Depression." But this isn't just numbers. For millions of Americans, this is their retirement vanishing. Families depending on dividends, 401ks, or short-term investments suddenly had nothing to fall back on. Interest rates are surging. Prices are climbing. A simple lunch now costs more than a full day's minimum wage. Manual workers, delivery drivers, school teachers are watching their savings disappear before they can react. The big question is, who will rescue them from this freefall when economic stabilization policies are still under discussion? Policies miss the people. Trust in politics crumbles. According to a Rasmussen poll, a traditionally right-leaning source, Democrats lead Republicans by 4 percentage points. This isn't just a shift in polling. It signals a deep fracture in political trust. Why? Many voters say they feel recent policies serve only the elite class, failing to address real hardships like unstable employment, unfair taxation, and lack of transparency in public spending. One glaring example, a plan to cut $4.5 trillion in taxes for the ultra-wealthy, while simultaneously proposing to slash $880 billion from Medicaid, the health program for the poor and elderly. People are asking, when hospitals shut down, when medicine becomes unaffordable, do growth statistics mean anything anymore? Education, immigration, welfare, all under attack. Both Harvard and MIT face the threat of losing $3 billion in federal funding for not complying with policy directives. Letters from the administration demanded control over admissions, firing of faculty with opposing views, and elimination of diversity programs. Simultaneously, over 1 million immigrants were deported, many without proper legal process. Some were removed from the country without ever seeing a courtroom. The result? Millions of children left without parents, communities torn apart, and fear seeping into daily life. And it doesn't stop there. The Department of Education, though officially abolished, still operates to garnish wages from students who haven't paid off their loans. Recent graduates, barely making ends meet, are being financially strangled, while billionaires legally dodge taxes. Is it fair that a student is pursued for debt while the super rich enjoy loopholes? Data erased, trust broken, a cloudy future. When Harvard was sued, when science was censored, when weather, disease, and climate data were erased from federal systems. Americans began to ask, what is being hidden? A measles outbreak, widespread E. coli. Yet critical information is not reaching the public transparently. Meanwhile, the bond market is in turmoil, yields are spiking, and the probability of a U.S. recession in 2025 is forecast at 90%, according to Apollo Group analysis. Americans today are no longer just worried about gas prices or lunch costs. They're afraid that the entire foundation of their society is starting to crack. 53% of China's international transactions are now settled in yuan. The US dollar has hit a 3-year low, and prices for essential goods in the US have surged up to 15% in just 6 months. Is the dollar's global dominance quietly slipping away while most Americans remain unaware? The shift in global currency begins. For decades, the US dollar has been the bedrock of global trade. But that may be changing. China has become the top trading partner for more than 120 countries, with a total trade volume of $6.1 trillion, surpassing the US at $5.3 trillion. However, it's not just about the goods, it's about the currency. In a recent directive, China's central bank instructed its state-owned companies to prioritize the use of the yuan, RMB, in international trade. As a result, the share of US dollar usage in transactions with China has dropped from 83% to 43% within just a few years. This is more than symbolic. For instance, China and Saudi Arabia recently closed an energy deal denominated in yuan, a move that signals growing confidence in alternative financial systems, a declining dollar and rising consumer costs. This shift is already affecting American households. A smartphone that cost $800 last year may now sell for $940. Basic imported goods, such as clothing or electronics, are seeing price hikes of 10 to 15%. These increases are not solely driven by supply chain issues. They are compounded by the weakening dollar and rising tariffs on imported goods, particularly from China. To manage market instability, interest rates have been lowered, but this has further weighed on the dollar. As a result, American consumers are absorbing higher costs across the board, even as incomes remain flat. Will the traditional model of American consumption continue if everyday goods become less affordable? Consumer spending slows, economic pressures build. Recent economic indicators reveal early signs of strain. New orders for U.S. businesses have dropped by 22%. Exports fell nearly 28%. Consumer confidence has weakened significantly. This creates a challenging feedback loop. As prices rise, spending slows. Businesses respond with layoffs. Incomes fall. And spending contracts further. Many small enterprises are scaling back, while households begin cutting non-essential expenses. The ripple effects extend beyond individual homes, impacting broader economic stability. With demand falling and prices rising, can the economy sustain its current path? A new global system takes shape. This is not a temporary trend. It may signal a long-term realignment. China is expanding its international payment system called CIPS, designed to operate independently of traditional US-led financial channels. By integrating technologies like blockchain, this system aims to provide a secure, sanctions-resistant alternative for cross-border trade. If more countries begin trading in yuan, the global demand for US dollars will gradually decline. There will be less need to hold US Treasury bonds or use the dollar as a medium of exchange. And as global finance diversifies away from a single currency, the impact will be felt first by American consumers through the price tags on store shelves. Can a nation remain a global economic leader if its currency is no longer the preferred choice for trade?